let's get our viewers connected now because we are moving to our question answer session where we'll be having our live viewers. And today on the show, I have with me Pankaj Mathpal, MD, Opna Money Managers, who will be answering viewer queries. Good evening and welcome to the show, Pankaj. I will take Vijay's question. Vijay from Bangalore is on the phone line with me. Hi, Vijay. Good evening.
Hi, Kavita. This is Vijay from Bangalore. How are you?
Hi. I'm doing good. Thank you so much for asking. How are you?
I am doing good, Kavita.
So Vijay, the
So,
question that you've sent, I can see you investing in Axis ELSS. You also have DSP ELSS, Franklin India
yes,
ELSS, and you've been doing SIP in these three tax saver funds since 2019. And they all are
yes,
giving you good returns. But you also want to know
yeah.
if you should be extending your time horizon for next 5 years, or should you be switching on to other tax saver funds. So any specific reason why you're investing in so many tax saver funds, if or just tax benefit is the only intention?
Both, Kavita, tax saver as well as, want to invest in SIP. Both funds,
Okay.
right?
So as far as getting the tax benefit is concerned, that you can get by having just one tax saver also in your portfolio,
Okay.
and
Yeah.
you can diversify your investment in other regular mutual funds also. If you are okay with it, we might just go and ask Pankaj about that kind of strategy, because the tax benefit part is taken, and obviously you are an old tax regime payer, right? Taxpayer.
Yes. Yeah.
Yeah. Only in that scenario you can
And
claim this benefit. So, sure.
yeah,
Yeah. You want to ask something?
yeah. Yes, because I just want to diversify into different kind of tax SIP, not only in particular SIP. So that's why divided into three
Sure.
kind of mutual funds.
Sure.
So
Sure.
I'm
Sure.
right now I
So
need the same thing.
1.5
I
lakh
want to.
benefit. Yeah.
Yeah,
So
that's fine. Yes,
1.5 lakh
that's
benefit
right.
you can get from one ELSS fund also. Max to max you can just have two, and rest you can invest for your financial goals through a regular
Yeah.
mutual fund. You can also align your ELSS investment for your financial goals. I think Pankaj will be in a better position to explain all of this to you. Pankaj.
Okay. Yeah.
Good evening. Vijay, as Kavita mentioned, see, you have three funds in the same category. And if you want to invest like 50, it is possible that you invest in one fund or two funds only. But first thing, if you have three funds here, I'll suggest you exit this Axis Tax Saver Fund. The reason is that poor performance, though you said that you are getting good returns, but it is because you have been investing for a long time. If you compare the performance of Axis Tax Saver with others too, you'll find that it has not performed well in last um, 2 years, I'll say specifically. So I'll suggest you exit from this fund. Now, either you invest that 1 lakh 50 in these two funds only, the rest two funds in your portfolio, or if you want to add the third one, then I'll suggest you Motilal Oswal ELSS Tax Saver. The reason is that because that is the fund which has a focused approach. It has only 30 stocks in its portfolio, and there will be least overlapping with the rest of two funds in your portfolio. So first thing you have to decide whether you want to invest only in two funds, or if at all you want to add the third one, then you replace Axis Tax Saver with Motilal Oswal Tax Saver Fund. And as Kavita was mentioning, see, you should set up your goals, and accordingly you should invest in other funds also. So if suppose you invest for tax saving funds is 1 lakh 50, in addition to this you want to invest in other funds, I'll suggest that you can choose a multi-cap fund or a flexi-cap fund for a long term, so that you get diversification across sectors and across uh, market caps. So in multi-cap, I'll suggest you Nippon India multi-cap fund or Kotak multi-cap fund can be considered. And for flexi-cap fund, ICICI Prudential flexi-cap fund or Motilal Oswal flexi-cap fund can be a good choice.
All right. Pankaj, I think just like Vijay, a lot of other investors also who think that, just having tax saving mutual funds in their portfolio will just do the thing for them. Yes, tax saving and getting a tax benefit becomes a very crucial aspect of investing in those kind of funds. But then how can you align them with your financial goals also? As far as investing strategy is concerned, how different are they from your regular mutual funds also, Pankaj?
See, these tax saver funds are basically diversified funds only, but mostly we have seen that their allocation is in large cap. The big part of the asset is in large cap. So for a long-term financial goals, you can align these funds with those goals, especially for child education or retirement. Second thing, when you invest through SIP route, you know that each SIP has to complete 3 years, means the units which have completed 3 years can only be redeemed. So there is a lock-in of 3 years for the units from the date of allotment. So the best thing is that if you're investing in ELSS, always align that investment to your long-term financial goal and keep investing. So that can be helpful in tax saving as well as wealth creation. But Kavita, as you also mentioned earlier, the thing is now because that old tax regime, new tax regime, we have two choices. And in most of the cases, we are finding that the old investors who invested in these funds for tax saving, now they are switching to new tax regime. In that case, I'll suggest that they should think about it. Means if it is beneficial to move to that new tax regime, they should stop their investment in ELSS and invest in other funds.
All right, let's move on to our next viewer. Let's take Raghuveer's question. And Raghuveer says that his dad is 58 years old. He owns a house, has health insurance, and also owns a piece of real estate. Now, currently, he runs his own business, and through that, he covers all his expenses. And he wants to retire in a couple of years, but he's also worried about having a regular monthly income. So the idea over here is that they are thinking of is selling the land and investing 50 lakhs in mutual funds over the span of 1 year, and after leaving it to grow for almost 5 years, the growth they're expecting is 15%, and they want that money to go up to at least 1 CR. And for that, they want to understand how to go about it, what could be the investment strategy. They also want an SWP post 5 years of 1 lakh per month from that particular investment for the rest of the life. So how can they form a portfolio, investment portfolio for this?
Kavita, this question is very important. See, first thing, idea is very good that you want to sell the real estate and then want to invest that money in mutual funds so that you get better returns. But first thing, as Raghuveer, you have mentioned that you were expecting 15% return. Now here, because you want to invest for your father and the investment horizon is only 5 years. So in expectation of 15%, you should not take very high risk. So my suggestion that you should invest this money in large cap mutual funds or hybrid funds where the returns can be 10%, 12%. Your expectation should be that, but risk management should be the priority here. So do not expect 15%. If you get 15% from those kind of funds, that is good, but do not invest your money in mid cap, small cap, or higher riskier funds. I mean, that is first thing. Second thing, when you are saying that from the 1 crore rupees you want to withdraw every month 1 lakh, it means you are expecting 1% return every month. That is again wrong strategy. See, when you invest in mutual funds for SWP, first thing you should choose less riskier funds. So hybrid funds like balance advantage fund or aggressive hybrid funds can be a choice of funds. So again, you should not expect 1% every month, though even if the funds are performing well, you should withdraw a smaller amount so that capital also grows over time. And in future, if suppose you're starting with the 50,000, 1 lakh, in future you will require more amount than that. And that is only possible if you initially withdraw a smaller amount. So do not withdraw 1% every month, withdraw 0.5%, 0.6% only. So in this case, you should increase the investment amount so that you will have a bigger corpus. Do not expect very high return. Do not take very high risk. But it is good that you sell your land and invest in mutual funds. And take care of the capital gains also. When you sell the real estate, you'll have to pay that long-term or short-term capital gains, whatever applicable. And balance amount you can invest in mutual funds.
Can you also recommend what mutual funds? I mean, you did mention the categories, but what would be the specific names?
Yeah. So at this moment, I'll suggest like ICICI Prudential Multi-Asset Fund, which is a hybrid fund investing across equity, debt, and gold. And plus, you can also invest in HDFC Balance Advantage Fund. That is again hybrid fund. So these two funds would be a good choice.
Let's move on to our next question, which is from Shrikant Krishnamurthy, and he's investing in Nippon India Small Cap, 10,000 rupees SIP, SBI Small Cap, 10,000 again, Parag Parikh Flexi Cap, and Bandhan Small Cap, 5,000 SIP each, Quant Small Cap, 12,000, and Motilal Oswal Micro Cap, 8,000, Kotak Emerging Equity, 10,000, HDFC Mid Cap, 8,000, and his target is to achieve 3 crores in 15 years, and he wants to know if these are the right funds for that particular time horizon. So quite an interesting portfolio and super aggressive, which also includes micro cap, and that's currently a very strong flavor among investors also, micro cap. Pankaj.
Kavita, see, the amount is sufficient to achieve the goal. But thing is, out of 68,000 per month, he's investing 45,000 rupees in micro cap and small cap. So, which is really means not correct plan, I think. And in mid cap, 18,000 and only 5,000 flexi cap. So, I'll suggest to change the portfolio. And out of this only, whatever schemes he has, I'm suggesting some changes. So, in Parag Parikh Flexi Cap Fund, Srikant, you can invest 30,000 rupees per month. Kotak Emerging Equity Fund, which is a mid-cap fund, 10,000 per month. HDFC Mid-Cap Opportunities Fund, 10,000 per month. Nippon India Small Cap Fund, 10,000. And Motilal Oswal Micro Cap Fund, 8,000. So again, this is also an aggressive portfolio, but not like the one you have misdesigned yourself. Some suggesting some changes. It will be better than what you have decided. So the funds are out of those only what you have selected, but lesser funds and consolidation of portfolio.
All right. So that's the new formation for your portfolio, Shrikant. Parag Parikh Flexi Cap, 30,000. Kotak Emerging Equity, 10,000. HDFC Cap, 10,000. Nippon India Small Cap, 10,000. Motilal Oswal Micro Cap, also 8,000. Now, talking about small cap and micro cap category, Pankaj, if one really goes very aggressive and has a major chunk of their portfolio, and for a time frame for like 15 years, this is quite a decent time frame to ride out your risk that you might have from these particular categories. Isn't that enough, or one should really look at decreasing their exposure in these categories, even if it is a long time frame?
Kavita, I mentioned very clearly, because if you look at the portfolio, he has 45,000 rupees in these funds. So I understand that he wants to take risk in expectation of high return. So I tried to minimize that. Still, I'm saying it's a very aggressive portfolio. If had he been on the phone call, we could understand that why he has chosen such funds. But in general, I'll say that in small cap, your allocation should be limited to 15-20% only. And that too, instead of investing directly in small cap, if you have exposure through multi-cap fund, flexi cap fund, that is better. Because when there is a correction in market, we have seen that investors, most of the time, they exit from those funds. So that is why your major allocation should be large cap, some in mid cap, and small cap should be much lesser than this. But because as the portfolio was designed, I have tried to change it so that the risk is lesser comparatively.
All right, let's move on to Panditurai from Chennai. He's our next viewer's question. His portfolio consists of 16% hybrid multi-asset, 20% thematic, 14.2% PSU fund, 20.3% dynamic asset fund, 7.6% sectoral fund, 18.17% flexi cap, 3.6% value-oriented funds, and 2.3% each in small mid-cap categories. And he's retired, and monthly cash flow needs are already covered. So whatever he's accumulated in terms of investment, this portfolio represents that, and he wants to know if he can reduce any allocation from any fund category. We don't know the name of the funds, but then yeah, definitely his category exposure. Pankaj.
Kavita, though he mentioned that he doesn't need money for the regular cash flow, he has covered his expenses. But I'll say that the kind of funds he has, allocation in thematic funds, sectoral funds, or small cap fund, that should be avoided. So he should have a portfolio majorly in large cap, multi-asset allocation, and dynamic asset allocation funds. So I'll suggest that Raghuveer, you exit these thematic, sectoral, and small cap funds, and increase your allocation in multi-asset allocation, dynamic asset allocation. Second most important thing here, because most of time when investors, they invest in multi-cap, multi-asset allocation, and dynamic asset allocation or balance advantage fund, So they think that all the funds are same, but I'll tell you that these categories, means funds in these categories are managed very differently. Some follow cyclical, counter-cyclical style. Some follow cyclical style. So pro-cyclical style. So when you choose the fund, you have to be careful. So in this case also, when I'm talking to Raghuveer, about Raghuveer's question, I'll say that he should have funds where risk is controlled better. So like if I take example of multi-asset allocation fund, here ICICI Prudential multi-asset allocation fund or ICICI Prudential balance advantage fund, where the downside risk is more protected, though the returns can be comparatively lesser than the pro-cyclical funds, will be a better choice. So one thing that you should avoid, this thematic and sectoral. Second thing, within that hybrid also, you should think about the funds where the downside risk is protected more.
All right. I think that will be all. Thank you so much for being on the show and helping our viewers with their portfolio queries today, Pankaj. On that note, it's a sign off from me also on The Money Show, but I'm going to leave you with our WhatsApp number and email ID. Thank you so much for watching. Goodbye.
If you like this video, then like, share and subscribe to ET Now.